Good morning, my name is Michael Pate. I'm standing in for Paul Kavanagh this morning on the 10th of February for this week's podcast. Firstly, looking back at last week, we'll come back to the week ahead. We saw a fairly nervous week for emerging markets, and here we've got a chart just illustrating the divergence of performance between emerging markets and developed markets since May of last year, when the Fed decided they would first announce they'd start tapering. Here you can see this initial announcement led to quite a marked underperformance in emerging markets, and we've seen post the December taper announcement that's continued. The issue here is that you're starting to see capital coming out of emerging markets. You can see from the 5 weakest emerging market currencies since May the 23rd that this process is very much in train. This has a self-reinforcing mechanism, as that is actually leading to weaker commodity markets and weaker oil prices, which is improving the performance and economic strength of the developed markets, and therefore you're seeing more policy tightening in developed markets, which is exacerbating the problem. So it's very interesting last week to look at the non-farm payrolls. Since the start of the year, the economic surprise index in the US has been disappointing, so US economic numbers have been coming in short of expectations. That occurred again on Friday with the non-farm payroll, the big jobs number that's keenly watched. That came in well below consensus, and you can see from the initial reaction that the market in the States sold off fairly aggressively. That subsequently bounced very quickly as I think people looked at the actual unemployment rate, which came down, and just looked at the sort of other circumstances, such as the weather, which has been the worst since 1977 in the States. So the market actually continues to go up following that number. Also last week we had the ECB reporting. Again, there was an expectation potentially for some monetary easing or rate cut in the ECB. That didn't happen, and as you can see here, for the first time in a long time, the Japanese inflation rate went above the European inflation rate, and that's sort of symptomatic of the European banking system and the fact that people feel that the transmission mechanism for liquidity in Europe is still blocked. So one would expect more action in March when they meet again. Last week on the stock side, we had some big US social media stocks reporting, Twitter and LinkedIn. Twitter was very disappointing in terms of their user growth. LinkedIn beat their numbers. The reason why we're interested in this is we see the mobile advertising market as a very interesting, strong structural growth area. Here you can see the percentage time spent in media, and as you can see here, TV remains a very significant proportion of that, but mobile at 12% we think will continue to grow very strongly given different user habits. With only 3% of advertising spend in the US in mobile, we think that will be an exponential growth story. So within that, we've put out a new recommendation last week, being Baidu. Baidu is the Chinese Google, and as you can see, Baidu is a good way to play that growing mobile advertising spend story. Here we can see some of the drivers for the Baidu recommendation: increased smartphone ownership, increased internet penetration, growth of online shopping, and just a greater proportion of the advertising spend going to online. So we think it's a very strong story that we just initiated last week. Also last week we had George Osborne talking about the supply shortage of homes in the UK in the Lloyds Economic Affairs Committee. That we think is very supportive to ongoing strength in the house building sector. Another sort of feature of note was Illumina's announcement that they are now sequencing DNA, human being DNA, at under $1,000. This process has gone in costs from 2.7 billion per sequencing in 2001 to below 1,000. And this is interesting and relevant because it allows a personalisation of medicine, which is a key theme for us, which is emerging. Linking this to last week's results, we saw strong improvements in outlooks for drug pipelines for both Sanofi and Glaxo. And Glaxo have 10 cancer drugs in late stage development, which will benefit hugely from this new technology. Going forward to this week, Whole Foods is announcing on Wednesday. This share price has been slightly disappointing, probably something to do with the economic numbers coming out of the States. We've remained very positive about this stock. They're looking to open 1,000 stores in the US over the next number of years. And we feel that will strongly drive earnings and bring that multiple, which appears on the face of it quite high at the moment, down to very attractive levels. Given their unique positioning in healthy organic food, we think they've got a strong brand differentiation there. Also, we'll have Lloyds, who pre-announced last week, just confirming their numbers. We still feel that this stock can go quite a long way from here. If you look at the valuation of Lloyds on a price-to-book basis, we're still only at 1.5 times, and if you go back to recent history, 2007, ahead of the financial crisis, they traded nearer 3 times book. So as the government allows them to start lending more, start paying that dividend, we think a revaluation of Lloyds can continue and go quite a long way from here. Finally, we've got Rolls Royce on Thursday as well. This share price has been a touch weak due to serious fraud investigation, which we feel they'll hopefully be let off with a fairly minor fine in the context of the business. They've also been looking at an acquisition, which has led to a little bit of nervousness amongst holders, but we feel that it's a good buying opportunity, and the long-term thematic drivers of that stock remain very, very strong. And here you can see the annual production forecast for engines going out to 2032, which is 40% higher than current levels, which is hugely supportive for Rolls-Royce. So that's it from me. Thanks very much.